Value investing is a strategy that involves buying stocks that are trading below their intrinsic value. Intrinsic value is the value of a stock based on its underlying fundamentals, such as its earnings, assets, and cash flow. Value investors believe that the market often misprices stocks, and that by buying undervalued stocks, they can generate superior returns over time. There are a number of different ways to value stocks. One of the most common methods is to use the price-to-earnings ratio, P/E ratio. The P/E ratio is calculated by dividing the stock price by the company's earnings per share, EPS. A lower P/E ratio generally indicates that a stock is undervalued. Another common valuation metric is the price-to-book ratio, P/B ratio. The P/B ratio is calculated by dividing the stock price by the company's book value per share. Book value is the net asset value of a company, calculated by subtracting its liabilities from its assets. A lower P/B ratio generally indicates that a stock is undervalued. Value investors also look at other factors when evaluating stocks, such as the company's management team, its competitive landscape, and its potential for future growth. Here are some tips for value buying stocks. Invest in companies with strong fundamentals. Look for companies with healthy earnings, strong cash flow, and low debt levels. Look for stocks that are trading below their intrinsic value. Use valuation metrics such as the P/E ratio and P/B ratio to identify undervalued stocks. Invest in companies with a competitive advantage. Look for companies with strong brands, proprietary products or services, and high customer loyalty. Invest in companies with a good management team. Look for companies with experienced and ethical management teams. Invest for the long term. Value investing is a long-term strategy. Don't expect to make quick profits. Here are some examples of value stocks that you may want to consider. Banks. Banks are often undervalued during periods of economic uncertainty. Look for banks with strong balance sheets and low loan losses. Consumer staples. Consumer staples companies sell products that people need to buy regardless of the economic climate. This makes them a good investment for value investors. Energy companies. Energy companies can be volatile, but they can also be very profitable. Look for energy companies with low production costs and strong cash flow. Real estate companies. Real estate companies can be undervalued during periods of rising interest rates. Look for real estate companies with a strong portfolio of properties and low debt levels. In addition to the above, here are some other tips for value buying stocks. Do your own research. Don't just buy stocks because someone else tells you to. Take the time to understand the companies you're investing in and why you think they're undervalued. Be patient. It takes time to find the best value stocks and to see your investments pay off. Don't get discouraged if you don't make money overnight. Diversify your portfolio. Don't put all your eggs in one basket. Invest in a variety of different stocks to reduce your risk. Value investing can be a rewarding strategy, but it's important to remember that there is no guarantee of success. The stock market can be unpredictable, and there is always the risk of losing money. However, by following the tips above, you can increase your chances of success as a value investor.